Welcome back. In this lesson, we're going to talk about accounting for income taxes. First, we're going to talk about why that's an important concept for us to understand. But then we'll introduce to you the idea of book tax differences, both permanent and temporary. Then we'll introduce to you deferred tax assets and liabilities and how those impact our calculation. Then we'll run through an example of calculating income tax expense for financial statement reporting purposes. So why is it important for us to talk about accounting for income taxes? For book purposes, revenues and expenses are developed using a concept of fair representation. The point of creating an income statement is to communicate to investors and other potential users of the financial statements how the company has done for a period of time. Taxes, on the other hand, are given to us really to create public policy or to generate economic investment. Because the purposes of recognizing income for tax purposes is different for the purpose of recognizing it on our books, we end up with two completely different sets of standards for recognizing income and expenses. For book purposes, we want to record income tax expense that relates to our book recognized income and expenses. But we also need to consider the fact that there is a tax income figure that's also playing into this picture. This is why we need to talk about how to deal with accounting for income taxes. So first, let's start by looking at the types of differences that we see between book and tax income. The first kind of difference we have is called a permanent difference. These are differences that never reverse, meaning we're going to have something that is non-taxable from a tax perspective, but it might still be revenue for book purposes. For example, municipal bond interest is never taxed, yet it's a revenue for book purposes. Similarly, if a company has life insurance proceeds from a life insurance policy they've kept on maybe an officer of the company, those life insurance proceeds are not taxable. But again, they would represent income from a book perspective. Finally, certain dividends that we receive from investments in other entities would be excluded for tax purposes. So similar to this idea of non-taxable revenue, there are certain expense items that are non-deductible. Specifically, if we have any expenses associated with generating non-taxable revenue, because the revenue is not taxed, the expenses associated with that revenue is also not deductible for tax purposes. But again, it still represents a business expense that would be included in our book expense. In addition, fines and penalties are not tax deductible. The government does not want to support bad behavior. We may have a legitimate business expense that is a fine or a penalty, but it will not be able to be deducted on the tax return. Similarly, 50% of any meals or entertainment that is expensed by a company is non-deductible for tax purposes. So what about temporary differences? These are differences that will reverse over time. It just represents a timing difference between when we're going to recognize something for book purposes and when we're going to recognize it for tax purposes. So a couple of examples here are revenues and expenses that are in different periods, are long-term construction contracts. Many times we'll see that for tax purposes, the revenue associated with a long-term construction contract is recognized in a slightly different period than what we do for book purposes. Again, simply because we have two sets of rules being applied to the same transaction. Any estimated expense that we have included in our books, such as the allowance for doubtful accounts or warranty expenses, are non-deductible until we actually incur the cost. So again, we will incur a cost at some point, but the timing of when we get to deduct that expense is different than when we expense it in our books and records. Similarly, depreciation expense for book purposes is often done on a straight line basis. But for tax purposes, most of the time, depreciation expense is some kind of accelerated basis. Over the life of the asset, we will expense the same amount in our books that we will ultimately deduct in our tax returns, but the timing will be in a different period. And finally, certain investments in other entities, if they are taxed, if it's not a permanent difference, the tax will often occur at a different time frame. We recognize gains and losses on investments in other companies when they happen, meaning when the stock rises or falls in value. But for tax purposes, we don't recognize gains or losses until we actually sell the investment. So you can see we're ultimately going to recognize the same amount, but just different time periods. Now that we have an understanding of the kinds of differences we might see between book and tax accounting, let's talk about which kinds of differences create deferred tax assets and liabilities. Permanent differences do not create DTAs and DTLs because they will never reverse. A deferred tax asset or liability then is something that results solely from a temporary difference. It's because we have a timing difference that we need to defer the tax. So let's look at what creates a deferred tax asset. When we have taxable income that happens in our tax return before it happens in our books and records, we generally will have a deferred tax asset. When we have a deferred tax liability, it's generally because we've had book income before we've had taxable income. Now remember, income is the result of revenues and expenses. So there are two cases for each of these that might generate a DTA or a DTL. Let's look at the two cases for a deferred tax asset. If we were to have a book expense that happens before it shows up in our tax return, that means that our taxable income will be higher in the earlier year, and then in the later year, our book income will be higher. So we have taxable income before we have book income. This is a DTA. Similarly, when we have taxable revenue before it shows up in our books and records, we also have a situation where tax income before book income, DTA. So over here with our deferred tax liabilities, when we have a tax deduction before we get to recognize the book expense, we now have a situation where book income is higher in an earlier year, and then taxable income is higher in a later year. This creates a deferred tax liability. Similarly, if we have book revenues that are recognized in a year before they show up in our tax return, that's going to also create a deferred tax liability related to this timing difference. Let's go through two examples. The first we'll look at is a deferred tax asset. So we have Company C who's receiving a $1,200 payment in December of 20X4, so it's happening in 20X4, but it's for revenue that we will earn in 20X2. Remember, from a revenue recognition perspective, we don't get to recognize this revenue until we've done something to earn it. So we'll record this receipt of cash as deferred revenue or a liability in our books and records. The tax rate in this year is 30% and in all future years. And for book purposes, as mentioned, we'll wait until the 20X5 year before we begin recognizing revenue. But for tax purposes, we're actually required to record this as taxable income in the year we receive it. This is from something we call the wherewithal to pay concept. The government says, look, if you have cash on hand, then we're going to make you pay the taxes as well at the same time, regardless of when you recognize it for revenue purposes in your books. So because we actually have to record this as taxable income in the current year, we're going to record a current tax expense for the amount of tax that we pay in the year of receipt. So how much will that be? Well, we've got $1,200 of cash and we have a 30% tax rate. So that means we're going to actually pay tax of $360. So we're going to record that by recording a current tax expense and a tax payable. This is going to represent what we actually will pay to the government in this year. $360. But now, because if we were to look at our income statement, we have no revenue in 20X4. In fact, let's put that up here. We're looking at 20X4 right now. We have no revenue in our books and records. And if we left this tax expense here, it actually would look strange to have zero revenue but pay a tax. So instead of leaving that alone, we will say, actually, this tax payable was really paid sort of in advance. It's almost like we prepaid the tax on the revenue before we're going to recognize it in our books. So at the same time we record this entry, we're also going to record a deferred tax asset for $360 and a deferred tax benefit for $360. Now this account and this account, so current tax expense and deferred tax expense, both show up in our income statement. If we put both of these numbers in our income statement, what happens to our tax expense overall? It's a combination of these two numbers. So tax expense in this year is actually zero because we have one debit for the current tax expense and we have one credit for the deferred tax benefit of the same amount. Now, if we look at our income statement, it actually makes some sense. We have zero revenue and we have zero tax. Let's look at what happens though in 20X5. Remember, this is the year that we actually get to record revenue in our books and records. We've now done what we need to do to earn this revenue. So as the subscription continues throughout 20X5, we'll recognize that revenue. So by the end of the year, on our books and records, we will have recognized $1,200 of revenue. Now, if we don't do anything, we'd show $1,200 of revenue and no tax expense because we've already paid it. But again, that doesn't really make sense. So what we're going to do is come back to this deferred tax asset. Now we're actually going to write this asset off and recognize the expense. So we'll make this entry. Deferred tax expense, $360, and deferred tax asset, $360. Now we can see that the asset we started with in the beginning of the year has been written off, and we show tax expense in our income statement of $360. So if we were to step back and look at our entire income statement, we see revenue of $1,200 and tax expense of $360. We've effectively matched the expense in the same period that we recognize the revenue for book purposes, even though we've already paid the tax in the previous year. This is what having a deferred tax asset allows us to do. We always want our income statement to reflect tax expense associated with the book revenues and expenses that we've recorded in the period. In this example, we'll see what happens when we have a deferred tax liability. So Company D has pre-tax income before depreciation expense of $200,000. So what we mean by that is this is all of the revenues and expenses of the company except for depreciation expense and tax expense. So that number before those two expenses is $200,000. For book purposes, their depreciation is $50,000, and for tax purposes, their depreciation is $100,000. So this is a typical situation where we have a company recognizing tax deductions for depreciation in excess of what they have recorded as book expense for depreciation. In addition, they have a tax rate of 30%. So what we need to do at this point is figure out what tax will they be paying during the year and what tax expense should we be reflecting in our books and records, and how do we reconcile the two? So what will they be paying for tax in the current year? If they have pre-tax income before tax deduction or depreciation deductions of $200, and our tax depreciation deduction is $100, then their taxable income will be $100,000. So this is the amount that will actually show up in their tax return. And they're really going to pay 30% on that number, or $30,000. And just like we saw in our last example, when we have an amount that we pay, we record current tax expense. So, current tax expense of $30,000 and tax payable of $30,000. So this represents the amount that actually gets paid with the tax return for this particular year. But remember, on our books and records, we want to reflect a tax expense that is compared to our actual book income, not just our tax income. So for book purposes, we're going to recalculate our pre-tax income. Remember, income before taxes and depreciation was $200,000. So our book depreciation is $50,000. That means our pre-tax book income is $150,000. So we want to show our tax expense that matches our book income. So 30% of that number is actually $45,000. So what's happening here? I've already expensed $30,000 because I paid it. But I have additional income that I'm recognizing on my books this year because of this difference between the amount I get to take as a deduction for depreciation on my tax return and the amount that we've expensed in the income statement. That $50,000 difference is what's creating a difference in my income. So I need an additional $15,000 of expense. We're going to call that deferred tax expense, and we'll create a deferred tax liability for $15,000. This is essentially saying that in some future year, I'm not going to have a larger tax deduction for my depreciation. And in that year, I'm actually going to pay a higher amount in tax than what my income statement might reflect. So I'm going to record that liability today because it's generated from my income this year. If I look at the two amounts that show up in my income statement, both current tax expense and deferred tax expense, I get the $45,000 that I need to reflect my total tax for the period. Now I have a 30% tax rate, just like I expected, on my book income for the period. Now that we've seen how deferred tax assets and liabilities get created, let's look at a calculation of the total tax expense for the period. So we always start with pre-tax book income, and we make adjustments for any items that are permanent differences. Remember, these are the differences that do not create deferred tax assets and liabilities because they never reverse. They will always be a difference between book and tax income. Once we take out or add back anything that is a permanent difference, we come to a number called income to be taxed. This is the amount of book income that will at some point be subject to tax. Maybe this year, maybe in a previous year, maybe next year, but at some point it will be taxed. From this number, we will add or subtract any temporary differences that exist. These are differences in the current year between book income and taxable income that will reverse. Once we've adjusted for temporary differences, we have taxable income for the current year. We will then apply our current tax rate to get our current tax expense. We've seen this happen twice in the two previous examples. The final piece to our total tax expense is the change in the deferred tax assets and liabilities for the period. Anytime those change, the offset will be deferred tax expense or benefit. When we combine deferred tax expense or benefit together with our current tax expense or benefit, we get total tax expense for the period. In this example, we're going to calculate total tax expense. Company X reported $200,000 in pre-tax book income in its first year of operations. Book income included $15,000 of municipal bond interest and $10,000 in expenses for environmental fines and penalties. Remember, these are things that are permanent differences, so they will never be in part of our tax return. So the revenue will never be taxed and the fine will never be deducted. But both of them are going to show up in our book income. They're already in that $200,000 number. So we need to make an adjustment to pull them out. So if we start with our pre-tax income of $200,000 and we want to remove the impact of the municipal bond interest, we're going to have to subtract $15,000 because the interest is already included as revenue in that number. Similarly, the fine is already included as an expense to get us to that number, so we're going to add it back to take out the impact. So now we've come to the amount that will be taxed at some point in the company's timing, either this year or next year or maybe even a previous year. But this is the amount that will be taxed at some point. Now we can see that Company X received $30,000 during December of this year as a payment for services that will be rendered in the next 2 months. None of that amount gets included in book income because we haven't earned it yet. But for tax purposes, we will have to pay tax immediately. So because it's not included in our number here, we're going to need to add it in. So here's our $30,000 of deferred revenue. Now, unlike our municipal bond interest and the fine, this is a timing difference. Eventually, this will show up in our book income figure. So we're going to star that because we're going to come back to that to create a deferred tax asset or liability. Now that we have our adjustments, we can see how much we will pay tax on in the current year. So $225,000 is the amount that will show up as taxable income in our tax return. And if our tax rate is 25%, that means we're going to pay $56,250 in tax. When we make that tax payment, we'll record current tax expense of $56,250 and tax payable of $56,250. So this, remember, is only part of what we need to do for our tax expense for the period. We need to come back and revisit this deferred revenue. Remember that this number includes that deferred revenue in terms of the tax that we've paid. We've essentially paid it before we're going to recognize it as income. So if that's the case, then it's like we've prepaid that tax. So how much of this tax relates to our $30,000? Well, $30,000 times 25% gives me $7,500. So of this $56,250, $7,500 of it relates to this deferred revenue. That's the amount of the asset that we're going to record. Deferred tax asset, $7,500, and we'll record deferred tax benefit of $7,500. And again, the benefit and the expense together make my total tax expense for my income statement. Those two numbers together equal $48,750. That's the amount of total tax expense. It includes both my current tax expense and my deferred tax benefit. And here's a really fun way to just double check that we got this right. We can come back here to this number. This represented everything that would be taxed at some point that's included in my books and records right now. 195 times 25% is $48,750. Now we know we've appropriately accounted for all of the tax expense necessary for this particular company. Now that we've been through this lesson, let's review some of what we've talked about. Remember that permanent book tax differences do not create deferred tax assets and liabilities because they never reverse. Remember that temporary book tax differences do reconcile at some point in the future, and because of that reconciliation, that's where our DTAs and DTLs come from. Remember also that total tax expense is the combination of two numbers: current tax expense or benefit for the year and deferred tax expense or benefit. The two together make total tax expense for our income statement.